Hey, no
Glad
need
that
for
missed.
go ahead, Alex.
We got a multifamily off market, 7 units in Waikiki. It is CPR'd already, so it's individually titled. It is a very low cap rate. It is a 2.8 cap rate at its current condition. If you guys are interested, let me know, and I'll send
What
it
is
over to you.
Alex, what's the specs on it? How many units, how many beds, how many baths?
They are, I believe, all one ones or 1 2s.
1 1s or 1 2s. Okay.
Or 2 1, two
I was
one
gonna
and
say
1 1.
one bedroom, 2 baths. That's perfect.
Yeah, little wet bar.
And then what do you know what street? Is there ocean views?
No ocean views. It's like I think it's on the backside of Waikiki towards the Alawai.
Gotcha. How many units?
It's 7 individual.
Okay. How many? How much is the list?
I think he's wants like 2.3, I believe, for it.
Wow, 2.3 for 7 units.
Mm-hmm.
Gotcha. 328,000. Hey, Jonathan, that might be an interesting Airbnb type / hostel type thing for young 20-something travelers. Oh, he took a look at it already?
Yeah, I don't think it's not legal STR.
Oh, that's a bummer.
Yeah, so it kind of crushes it there.
That's cool. Okay, cool.
But it's still really interesting. I mean, so like you said, 7 units at that price and that location is interesting. If somehow if it was allowed for a STR or a short-term rental, rather, it would be awesome. Because that screams boutique hotel with like a little bit of renovation.
Yeah, it totally does. And that's what would be really cool down there is that there's not very many boutique type hotels where you can even rent out the whole thing. In Vegas, there's some boutiques where you can bring like an entire family reunion and get the whole building, which is kind of cool, or get the, like a whole corporate retreat. So, and Waikiki doesn't have that. So that could be a niche. We should go into that together, Jonathan.
Yeah, I'll definitely keep an eye out for it. And I got to start poking around in Vegas too. I keep hearing it.
Dude, come on out anytime. We got a couple doors down there we're working on.
I love
Roshan's asking what Roshan. How do you say your name? Roshan? It's a cool name.
Roshan.
Yeah. Roshan's asking what an STR is.
Short-term rental. That's what I just heard. Is that correct?
Yep, correct.
Cool. Thank you.
Short-term rental. If you didn't get a chance to listen to the Coffee Talk with Jonathan Dempsey on it, look that up on our Facebook page because it was amazing. That's what Jonathan does is Airbnb, short-term rentals. He's crushing it. What's your passive income right now, Jonathan?
I think I'm around like 40,000 a month right now in passive.
So if anybody wants to, learn how to live like financially free, 40,000 a month should do it. I mean, should kind of do it, unless you're driving around Ferraris every single day, a different color to match your shoes like Alex would. But for the rest of us, 40,000 is pretty solid. So yeah, for anybody who didn't get a chance to listen in on Jonathan's, you definitely got to go look up that last one.
I'll tell you, it goes a long way, except for there's always another deal in the pipeline that you have to put down for. So It's never enough.
Well, and then it's just like, what are you going to do? Like retire? That'd just be no fun. Like half the adventure of real estate is the chase and the negotiations, right? And putting it together.
Exactly.
So, but yeah, no, that's fantastic. So we're going to definitely want to talk about that some more. And then today, one of the questions I was hoping you would ask our guest is how do 1031 exchanges work for short-term rentals? So if that doesn't get brought up, will you bring that up?
I am definitely going to bring it up because I'm trying to do that for the purchase here. I'm going to sell one of my places in Philly to purchase over here, and I want a 1031. So it's a short-term rental to short-term rental, and I'm going to ask them about it.
Perfect. That'd be awesome. So yeah, I would be really curious about that as well. Somebody else had some sort of need or something before Alex Young cut them off.
No, I cut him off. He didn't cut me off. All good, all good. I super want to know about the 1031 exchange for short-term rental because I got a client looking to do that. So thank you for bringing that up. But this question is actually for everyone, not really a need for money or anything, but just a need of location. I'm looking to do short-term rental properties. Traditionally, I've been more long-term buy and hold. Where are you guys seeing the best markets are at right now? I know it fluctuates. I know there's a lot that goes into that, but where are you guys buying?
Anybody want to jump in on?
I'll jump in. I just came back from a little bit of a couple of tours, and one of them was in San Antonio. My buddy has 130 doors there, and 45 of them are on short-term rentals. Apparently, there's only about 12% of the city can be allowed the license. But once you have a license on that property, it stays with it. It's like grandfathered in. And if you're close within downtown, you can buy a house for probably about $250. That could bring in around $5,000 of gross income, stuff like that. Numbers like that I think are very appealing. So I would look into that market if I were you. Close to downtown, in the 200s, ideally in the 100s. Short-term rental, get the license. It's not that hard to get the license as well.
So 250,000 will get you a property that you could do a STR in, makes you about gross 5,000 a month.
So general numbers, yeah.
Yeah.
And he's got 45 of them, and he's trying to convert as many more as he can of his long-term rentals into the short-term rentals.
That's awesome, and that's a pretty strong market for people wanting to visit San Antonio.
Yeah, things have opened back up. I mean, it's not as fun and electrifying as Austin, but I mean, it's got a lot going for it. So I wouldn't overlook it. I'm looking to try to buy something there pretty soon.
Yeah, well, and it's a fraction of the cost of Austin now. Austin was so cheap not too long ago, and now it's crazy. So yeah, you're right. Yeah, a lot of people are talking about San Antonio. So Matt, that's a good market to check out. Anybody else have a market you'd recommend? Solid. Well, Matt, hopefully that helps you out. Check out San Antonio.
Will do. Thanks, team. Thanks, Alex.
Sweet. Right on. Well, hey, it's just a reminder for everybody, in case you ever miss, there's a whole bunch of folks that can't come on during the time where we have Coffee Talk Live. So you're always welcome on our Facebook page to rewatch any of the former ones. And so we find that there's a lot of viewers there. Of course, when you're live, you get to ask the questions and help be a part of the dialogue, which is equally as much fun. So, but I want to jump right over to our guests, and then we can catch up on other stuff in a few moments at the end, because this is a really solid topic today. And a lot of us are real estate investors who are on the call. Kyle Williams is somebody based out of the Northwest, and he is somebody I've worked with personally, and we refer a lot of our clients to. And I'm not going to take away his thunder other than to say that he knows what he's doing. And anytime we have a client that is considering it, like, he gets the job done, he knows the ins and outs. And every single investor wants to figure out the best return they can get on their investment. And that usually means increasing income, reducing expenses. And if you can either reduce, eliminate, or defer taxes, huge advantage. And so none of us really want to pay taxes. So there's legal ways and illegal ways to do it. Kyle knows how to help us do it legally. So I'm going to let Kyle just kind of jump in. He's got a really short presentation to give us the behind the scenes of what a 1031 is, because some of us may not even know exactly what that is. And so we'll start with a little bit of that. And then at the end, we'll have a chance to ask lots of individual questions, because a lot of us have some different deals we're looking at. So with that, Kyle Williams, thanks for being with us today. Really excited to have you on, and your knowledge is saving us thousands of dollars in taxes, and we love it. So we appreciate you being here today.
Awesome. Thank you, Kakoa. Thank you, everyone, for joining us. As Kakoa mentioned, my name is Kyle Williams. I oversee sales in the state of Washington for IPX 1031. We are Fidelity's exchange division. So if you work with like Fidelity or Chicago or Tycor, or, lawyers, Commonwealth, Alamo, we're the largest, not only the largest 1031 QI, but the largest title and escrow company in the country as well. And I say this because it's super important to know. Most people don't know this, and I'll just preface this whole presentation with this. 1031s are entirely unregulated. Literally billions of dollars have been lost. It happens far more often than anyone imagines. And it can be the most ethical, knowledgeable little company in the world. But if there's, cyber theft, if they get hacked, whatever the case is, if that money's gone, they may have minimal protections that may cover you at like 20 cents on the dollar. So at the end of the day, our protections are unparalleled. So you will never lose money working with us. At the end of the day, that's why people work with us, is security and safety of funds. If you're like a broker or like a lender, you can always feel comfortable referring your clients to us from a liability standpoint. They will never lose money and come back and go after you. So again, keep that in mind. It's not to say that there's not other good 1031 companies out there. Just make sure you see what their protections are, because if they have something minimal like, $1 million Fidelity bond, or, something small like that, it's not serious. They need to have a decent level of protections to protect your funds. But as we get to the nitty gritty of 1031s, 1031s allow an investor to sell an investment property and use all the equity, not just the after-tax equity, to reinvest into something bigger and better. That's the key phrase there, after-tax equity. If someone sells for, say, $1 million and they've owned it forever, fully depreciated, instead of paying, we'll just round off and say 25% in taxes. Instead of only being able to reinvest 750,000, they get to reinvest that full $1 million. So as a lot of you know, and I see a couple of people that I've done exchanges with, as you know, that difference over like, 5, 10, 15 transactions, if you're not paying tax and you're getting to reinvest the full amount of equity, there's nothing else like it. I mean, it's literally the greatest wealth building tool in the Internal Revenue Code, because you can buy and sell, buy and sell, buy and sell, and never pay taxes. Most people will cash out, or they'll have some sort of strategy to cash out slowly and pay taxes along the way, but many people will exchange indefinitely. But our job is really just hold funds in a safe and secure manner. I cannot stress that enough. Make sure you always know who your qualified intermediary is and what their company offers for protections. But what's really cool about the 1031 is that you really just need to do two things. Buy for equal or greater value, don't touch any money, like reinvest all your proceeds. That's it. That's all you have to do in the exchange. If people look up rules about like replacing debt and stuff, that gets super confusing from a math standpoint. But as long as you buy for equal or greater value and reinvest your proceeds, everything else just falls into place from that math standpoint. So if we look at some taxes here, and keep in mind, there's applicable state taxes here as well if you're in a state that has an income tax. But we'll just look at it from a federal level because that's what 1031 is. It's federal. Capital gains at 15 to 20. Depreciation recapture. We call this the hidden tax because many people don't know about it until they've been hit by it. But that's taxed at 25%. So whatever you're taking in depreciation, that's taxed at 25% when you sell your investment property. I can't tell you how many people, more people than you think, will say, well, Kyle, my wife and I never took depreciation because we heard you had to pay it back. Well, yeah, taking depreciation is voluntary, but paying it back is mandatory. So whether you took depreciation on your investment property or not, you're going to be taxed on it. And lastly, we have the net investment income tax of 3.8% on top of really both of those, the Obamacare tax. So it's not uncommon at the federal level for people that pay 25% in taxes. So if we look at that example that I just talked about a minute ago, on the left-hand side here, we're not going to do an exchange. We're just going to do a normal sale, pay our taxes, and reinvest. So we sell for $1 million, pay 25% in taxes. There's $250,000 out the door. Leaves us $750,000 to reinvest in at a 75% LTV. Buys us $3 million in new property. Yeah, that's great, but we paid our taxes. On the exact same exchange, on the exact same transaction, if we do an exchange and don't pay taxes, that $1 million turns into $4 million at the exact same LTV. So as you guys know, the difference on $1 million of income is astronomical. 30, 40, 50, 60, whatever that number is, $1,000 a year. Spread that out over like 15, 20, 30 years, and that's just one transaction. As many of you know that have 10, 20, 50, 100, 200 doors, whatever the case is, you can really build a lot of wealth this way when you start selling your properties and scaling up. So like-kind property, this is one of the most common questions we get. Kyle, I'm selling a rental. Does that mean I have to buy another rental, or can I buy land with it? Can I buy commercial? Yes and yes. You can buy anything that's held for business or investment use. So this includes single family. This includes short-term rentals as well, because it's all about how it's held. So the better question is, well, what doesn't qualify? Because a lot of stuff seems to qualify. Personal use properties do not qualify. So your primary residence or your second home doesn't qualify. Flips do not qualify. So if you're a flipper, like you've worked with flippers, for example, instead of buying, fixing up, and selling and over and over and over again, they need to buy, fix up, and hold and get some rents on it. And then they're able to exchange, because the IRS views flips as just inventory property, which is essentially no different than home builders, for example, which is why they don't do 1031 exchanges. They can't, it's their business, right? The other one would be new developments to be sold. So you can exchange into a development if you hold it and like rent it out and everything. But ultimately, if you're just flipping it, it does not qualify. But all these things qualify for 1031 treatment. So in a lot of states like water rights and timber rights, Basically on the West Coast, most states qualify for timber rights and water rights. Mineral rights anywhere work. Air rights work. 30-year leases. So if you have like a 50-year lease and there's some sort of gain issue on it, that's exchangeable. Raw land, commercial, short-term rentals. So really all the things that you would probably invest in work. It's just, are you holding long-term for business or investment use, or are you flipping the property? That's kind of what separates 1031 from not being able to do a 1031. So then the question comes up, well, Kyle, well, how do you distinguish a flip? What is a flip? Well, the IRS has never defined how long you have to hold for before you do an exchange, but they've said flips don't qualify. They say it all comes down to intent. They want you to hold long-term for business or investment use. That's what your intent needs to be. But it's kind of open-ended. So a lot of CPAs that I've worked with over the years have said, you know, if we feel comfortable saying that if clients hold for a year and get some rents on it, they're going to be okay when they sell their property and do an exchange. Because elsewhere in the Internal Revenue Code, when the IRS says long-term, they mean 1 year or greater. Just because it's not specified in Section Code 1031 doesn't mean that that's not what they're referring to. Some conservative CPAs may say hold for 2 years just to be safe and remove all doubt. So it's ultimately up to your tax advisor. Many people don't feel uncomfortable exchanging after a year if they've been renting out. But again, we would always say defer to your tax advisor and see what they would say for guidance. Any questions so far? No? Okay. And we'll save some time at the end to pop in questions. All right, 45 days to identify, 180 days to close. But what starts the exchange? What's day 0? Close of escrow. That means your exchange has to be set up before close of escrow. And right now, it's about a week lead time before closing. And I get a call, I swear, I get a call once a week from a potential client that'll say, Kyle, I want to set up a 1031 exchange. I'll say, great, let's set it up. Where's escrow at? And they'll say, oh, it closed on Tuesday. Unfortunately, it's too late to set up an exchange at that point because the IRS would deem you have what they would call constructive receipt, meaning control of money. You can never have control of funds in a 1031 exchange, which is why you have to relinquish that control to a 1031 qualified intermediary, someone like us. So 45 days to identify, 180 days to close. There are 3 rules of identification you can use, and you can only use one of these 3 rules. The most common rule people use is the three property rule, meaning when clients sell their property, they can identify up to 3 new properties of any value to purchase. If that doesn't work, if they want to buy 5 or 6 properties and scale up, then they would go to the next rule, the 200% rule, meaning they can identify any number of properties, but collectively they can't total more than 200% of what they sold for. So if you sell that duplex in Berkeley for $1.1 million, that means that you could identify any number of properties totaling up to 2.2 million. So that might be, 5 or 6 rentals in Texas, for example, whatever you're comfortable with, but that would only be if you want to do identify and buy more than 3 properties. If both of those rules don't work, if you're buying a portfolio of properties that's obviously well over 3 properties and over 200% of what you sold for, you go to this last rule. I call this the all or none rule. It's technically called the 95% exception rule. But really, if you don't want to cap on anything, if you just want to identify whatever you want, you can do that, but you have to close on 95% of the value identified. Otherwise, everything becomes taxable. Because if you sell for 1.1 million and identify, 7 new $1 million properties and only close on 6 of those, well, that's not 95%. Therefore, the entire exchange has failed and it's all taxable. So the 95% exception rule, you don't have to remember that, but I would remember the 3 property rule. That's kind of a good rule of thumb. And if you guys run into issues remembering the other rules, just let me know and I'm more than happy to go over those with you. So 45 days to identify, 180 days to close. As you guys can see at the bottom there, these 2 run concurrently with each other. So after the 45-day ID period is up, there's an additional 135 days to close on what you've identified. Keep in mind, these are calendar days too. So Saturdays, Sundays, legal holidays, it does not matter. Nothing extends to 45 or 180 days outside of federally declared disasters. Here we are. So like big things like Hurricane Katrina, stuff like that. Even with COVID, there weren't full extensions issued. There were kind of partial extensions issued that expired in July of last year. But yeah, these are not super common. So you definitely don't want to start an exchange thinking that you'll be able to get an extension on it. Super, super rare for that to happen. Reverse exchange. So this has been popping up quite a bit because clients under that 45-day ID period, they're kind of under the gun. So they want to make sure that they can find a property they like, and they don't want to be able to, have to find something within 45 days. So they'll do a reverse exchange where they take their time finding the replacement property and close on that first. And then ultimately they have 180 days to close on their sale. The big difference is that in a normal 1031 exchange, like we've been talking about, we just hold funds as a qualified intermediary. In a reverse exchange where the client closed on their purchase first, we actually have to take title to that property, file an LLC with the state and everything, and take title of that property. That's not cheap to do. And financing is very, very hard. You generally need cash or hard money because when we set up a single-use LLC and require non-recourse language, traditional lending is basically thrown out the window at that point. So in a reverse exchange, you'd really need cash to purchase a property outright or hard money, which is super expensive to do before you refi it into a traditional loan. So ultimately, if you or your clients ever ask, can I close on this purchase first? Yes, you can, with some caveats. Make sure that they give me a call or you guys give me a call, and I can go over that in a little more detail. One other thing I'd like to talk about are DSTs, Delaware Statutory Trusts. This is kind of a new thing. I mean, the DST structure itself was really signed off on by the IRS in 2004. So they've been around for close to 20 years, but they're relatively new in the sense of popularity. But a DST is essentially a portfolio, or it could be an individual commercial asset where you're paying a trustee to manage it, and you and 25 other people are just passive investors into this property, but you own real property. So that may be, it may be like an Amazon warehouse. It could be like a large multifamily. It could be a portfolio of triple net lease properties like Dollar Generals and Starbucks, for example. But DSTs allow you to go passive. If at some point, it's getting to be too much, you might have 5 or 6 rentals in the area and you're like, I just can't deal with tenants anymore. Landlord-tenant laws are crazy. I love real estate, but I'd rather go another route. DSTs can work because your tenant at the end of the day could be like an Amazon. It could be a Starbucks, a Walgreens, whoever it is. But in many cases, you have a high quality tenant that is going to pay their rent every month. And ultimately, these are securities. So it's nothing that we handle. You have to work with an investment advisor that actually handles these. But it's something to keep in your back pocket at the end of the day if you ever want to think about going passive and you like real estate. The caveat with this is that you have to be accredited, which means net worth of $1 million or more, or basically you and your spouse have made a few $100,000 each of the last couple of years. But other than that, DSTs can make a great backup option for 1031s as well. But with that, as we wrap up, Kakao, let's open it up to questions. Has anyone shot anything in on the messages or anything?
That's great. Thanks, Kyle. That's awesome. A couple of quick questions there is, so you threw out the timeline, 45 days. So when somebody identifies those properties in 45 days, and then in those 45 days, do they need to be under contract for those? Do they need to prove by way of a signed mutual agreement? How does that work?
Good question. So they don't technically have to be under contract within 45 days. They just have to let us know in writing what they intend on purchasing. But as you guys all know, in this market, you want to be under contract because if you just put down a property on day 45, there's a good chance that by day 50, it's gone.
Yeah.
So you want to be under contract if you can. You just don't technically have to be.
So what happens if you identify 3 properties and you're not under contract, you try your best, multiple offers, you got none of them, and it's day 44. What happens?
Good question. So so if it's day 44, you can essentially relinquish your identification because there's very few guidelines we have to follow from the IRS and Treasury, but one of them is when we can return funds. Clients cannot use us as a bank legally. So as much as we would like to refund a client's balance, we can't refund it until after day 180 if they've identified properties and haven't closed on those properties. So we try to tell clients, and we actually make them sign off so they understand this, that if you identify properties and on day 46, you haven't closed, then you better close. Otherwise, we have to hold funds until day 180. So it's not a bad idea if you don't have anything, identified by day 44 or day 45 to just give up. And I don't want to say give up in the literal sense, but don't just put down properties just for the sake of putting down random addresses, because at that point we will have to hold your funds, assuming you don't close on what you've identified.
So basically, in a sense, if you don't want to kind of gamble and throw down a bunch of properties, you're basically going to pay taxes on that which you sold because your 1031 is now dead.
Correct. There's not a special penalty, but yeah, your 1031 has failed at that point. And then when we, return funds, a client is due taxes next April or whenever they file for the tax year.
Yeah. Okay, that's good. And anything special in the next days there? So then you got 180 total days. Everything's just sitting in escrow and just kind of working its way through. Nothing too crazy to worry about during that period.
No, but you can't have access to the fund. So that's a key thing, is that a lot of people will think like, yeah, I know what you said. I know what I signed about not being able to get money back, but I found this other property I didn't identify. I want funds for that. And it's like, we can't relinquish funds except for identified property. So even if a client finds something else on day 70, they need to close on what they've identified. Otherwise, we can't fund that purchase until after day 180. Yeah. So that's
it's a tight timeline for sure. I mean, it's stressful in that 45.
It absolutely is. And Kakao, because you've been through this, is that you want to start looking as soon as you're under contract on your sale, maybe if not even sooner. Because you can control the closing too on your sale. So maybe you have a 60-day close on your sale to give yourself those 60 days plus additional 45 to identify. At that point, you have 3.5 months to find property. Hopefully you can find something, but as the seller, in a seller's market, you kind of control when that closing is. So we'd say, be smart about it. Don't drag your feet on identification and wait until there's 2 weeks left. I mean, find something as early in the process as you can. If you can even close within 45 days and make it all a moot point, that's awesome.
100%. And in fact, for all of the realtors on the call today, this is a great strategy to really get to know 1031s, because there's not too many realtors out there that are proficient in what a 1031 looks like. And there is a way to buy time, and that is before the 45 days by, like Kyle said, helping your clients start looking for properties even before they're under contract, because that's all free time long before, and then you can align dates up so it lands within that 45 and the 180 window. So that works. Kyle, I'm going to ask another question. There's a few of other questions kind of chiming in, so that's great. But now, so your 1031, let's say that I'm selling a property and I've identified when I sell the property, I want to use Chicago Title as my closing agent and escrow agent. Sure. And typically what happens is then I send them my earnest money, and everything's going good. Now the money then when it sells, is going to sit there at escrow. Now, how does it get from escrow to you, and how do you get involved? What are the fees that 1031s charge?
Sure.
And how does that look like?
Yep. Good question. So the process itself, the 1031 process, is relatively easy. We'll do most of the paperwork with title and escrow. And if you're a client, your job is really just to find new property. We'll send you an exchange agreement to DocuSign, along with a couple other things, but super, super easy. And if you're a broker, your job is to help your clients find new property. But other than that, we'll do a lot of the paperwork, all the paperwork essentially, with title and escrow. But when you normally sell a property, you sell the property, you close, and then escrow wires money to your bank account. In a 1031 exchange, instead of them wiring money to your bank account, they'll wire money to us to a segregated bank account we open on your behalf and hold funds in. So at that point, everything's super, super easy. You let us know when you find new property. We'll work with the replacement property escrow to wire funds as the down payment or any applicable earnest money if needed. And then at that point, it's off to the races. So relatively easy. And 1031 exchanges are less than $1,000. That covers your sale and your purchase. Reverse exchanges, though, and like what we'd call build-to-suit exchanges, where we have to take title for a new build and cut draws to contractors, those would definitely be over $5,000, if not more. But yeah, your normal exchanges where you sell first and buy are generally under $1,000.
Awesome. Love it. Love it. Hey, Daniel Kong, you posted a question there. Why don't you go ahead and ask it and give us some context?
Someone was telling me that like something funky about the depreciation recapture. I just wasn't sure. I just wanted to get some clarification again. I guess like the like when you sell when you do a 1031, they don't do you don't recapture your depreciation, right?
Yep, correct. That's deferred in the exchange.
But then, so when you get your new property, do you get to take full depreciation for like the next 27.5 years for that full purchase of the new one or whatever
Good question. So you wouldn't, it would be adjusted based on your last depreciation schedule to the new one. So you'd have whatever was left on the old one. So you may have, 12 years at, 200,000 you're depreciating, and then 27.5 years at, 300,000. So it's going to be essentially tacked on top of what the old one was, but the old one will run out after, 27.5 years, and then you're just working on the new one at that point. So it can be blended basically with the old one.
Okay. So at a certain point, when you do like, let's say they use up all your depreciation in the last, let's say you held it for 27 years or 27 years. Then when you do a 1031, you're not going to get any depreciation on the new property. Is that, or?
No, you definitely can, but assuming it's more. So let's say in your scenario, let's say that you depreciated out, 200,000.
Mm-hmm.
And 27.5 years later, you exchange something and you can depreciate out $1 million on it, right? So really you're going to be depreciating 800,000 for the next 27.5 years because you've already depreciated 200,000. Now you get 800,000.
Okay.
Yeah.
Thank you.
Oh, that's interesting. So then to tag off of Daniel's so then if you were to exchange that property, which you have 800,000 left, into another property, and in that time you depreciated 400 of the 800, then you would roll 400 to the next one.
600, right? It would be 600 total, right?
So 200 to $1 million is 800, and then what was the last one, Kakoa?
No, I was just kind of asking the question, does it kind of roll forward? So as you keep exchanging, the depreciation recapture just kind of stays.
Yes. Yep. Absolutely. Yep.
Gotcha.
So it adds up, right? You're getting it's like you're going to take 200 for the first one, then 400 for the second one. So you have a 600, subtracted from whatever you have in the next property.
Yep.
Okay.
You need a really good CPA to track all that stuff, man.
Exactly. Yes.
I can't even remember what I spent for lunch yesterday. That'd be crazy. Daniel, that's a great question, bro. What other questions do you have since we're on you?
Nothing right now. I'll come back. Get back to me.
Actually, I'm going to ask a question on behalf of Daniel because he and I have the same situation. We invest in multiple states and we own properties in multiple states. So does a 1031 preclude you in any way of selling a property, say in Oahu, and then using those funds, say in Vegas?
Good question. So you can actually exchange, since 1031 is federal, you can actually exchange within all 50 states. Even Virgin Islands, not Puerto Rico though, but Virgin Islands work, and Guam under some circumstances. Last time I checked a few years ago, I think you have to show like 40,000 of income in that territory that year. But essentially 50 states, the Virgin Islands and Guam do qualify for 1031 treatment.
That's awesome. Well, 40,000, we'll just borrow Jonathan Dempsey's 1 month of passive income and we're good to go, right? So one more follow-up question on that, and then I'll let Daniel ask his. So then if you were to exchange, say, sell a house in Oahu for a certain number, can you then exchange into 3 other states, or that whole amount needs to go to 1 state?
Yeah, you can spread it out however you'd like.
Perfect. That's great.
Yes.
Daniel.
Well, so I mean, a lot of us have a lot of single family houses, like 100 grand, 100 grand, 100 grand. What's your thought process on, let's say, taking 5 of these guys and then trying to roll up into a bigger one? Or let's say I take 5 of them and I want to buy 2 properties or something like that to make it a little even more challenging for you. What's the best strategy, I guess, to make that work?
So I would say you guys would know, as well as I would, in terms of super, super savvy investors we work with. I would say Kakoa is definitely one. It's all
I'll send you money later. Thank you.
It's all about preference, right? You may be able to get a better cap rate on, a dozen, single family rentals in a college town, but the commercial property might be a little safer. It might be a lower cap rate, easier to manage, stuff like that. So it's just, there's so many different variables. It's not,
Well, I mean,
there's not a one-size-fits-all approach with any investors that we work with.
I guess the question is more like the process of like, so when I want to like roll up 5 into 1, then like, so I open up 1031 exchanges on all 5 of them. And then when I identify my property, all those properties, I just want to identify, like, let's say, so I open 1031 exchanges on all 5, and then all 5 would have the same 3 properties that I'm trying to roll into. Is that, and then I could combine, can I combine like the equity into like that new one?
You can, so you could really do it two different ways. One, you can set up an exchange for each one and combine it by one property, or because that's a little more expensive and more time consuming for us, you could combine the 5 sales into one exchange and buy one property. But ultimately, if all 5 sales are in one exchange, they all have to close within 45 days of each other, which, you know, you can kind of control in a seller's market, but you still only get 3 properties to identify. You still have the same targets and everything. So yeah, ultimately you can mix and match. And if you want to do that, you know, we can definitely go over stuff a little more in depth, but you can mix and match sales and purchases, any number.
Yeah. Oh, so I mean, I just wondering like how easy it would be. So like maybe the best strategy would be like get all, like, let's say when I like roll like as many as I can into the bigger purchase, but let's say, so I open up a 1031 on all 5 of them. And then I know how you said, like, let's say like one of those things doesn't close, but then all the rest 4 do. Can I just put like put those 4 into that one, and then like the one that it didn't close within that 45-day one? I mean, like, you know, would the 1031 still be valid even though this guy failed in that transaction, you know?
Well, yeah, I mean, if it doesn't sell, then it's not part of an exchange.
But then the 1031 would still be valid, because like, let's say I want to do one 1031 with 5 properties, right? And then like they all have to close within 45 days. I want to roll all 5 into this big commercial property. Okay. But then, like only 4 actually close. Is that still like a valid 1031? Like it doesn't like disqualify or?
No, it doesn't matter because that other one didn't even sell. So it's like, it's kind of a moot point, you know? So really you just sold 4 properties. You didn't sell 5.
Okay, cool. Thank you.
But if you sell it down the road, you can't use that to pay down debt or to go as part of that purchase. So FYI.
That's good. That's good. Great questions, Daniel. Jonathan Dempsey, our STR guy. What questions you got from STRs?
So I was just curious if there's any different implications as far as doing 1031 with short-term rentals. And then the other thing I wanted to know in general is just if the entity matters. So like what entity is selling the house, whether you own it personally or as an LLC. Good. When you buy new properties, are you allowed to use a different LLC for the purchase?
Sure.
For example, if you're selling 1 and then buying 3, a lot of people want to keep the LLC different on each property. Sure. So just speak to that.
So very good question. Investing is super important. I'll talk about that in a second. But as to short-term rentals, yeah, so I mean, as long as you get minimal rentals, like 14 days a year, and you're not using it for personal use, like it's not a second home, then that's fine. As long as assuming you're reporting the income and it's all fair market value. But yeah, I mean, there's not 14 days is really basically the minimum. So yeah, so if you want to rent it for 3 months or 6 months or full time, you know, every weekend, that's fine. It's short-term rentals don't matter. The IRS just wants to see, you know, that it's held for business or investment use. So that's perfectly acceptable. The other question with vesting, so the same taxpayer that's on title that sells needs to be the same one that buys. So like a single member LLC is a disregarded entity for tax purposes. So like the Kyle Williams LLC, that's just me, I could sell as the Kyle Williams LLC and buy as the Kyle Williams 2 LLC if it's just me, because it's the same taxpayer. But I couldn't buy as the Kyle and Jonathan LLC because that's a completely different taxpayer altogether. So if the Kyle and Jonathan LLC sells, the Kyle and Jonathan LLC needs to buy because the same taxpayer on title that sells needs to be the same one that buys.
Okay, so it all boils down to the taxpayer in terms of whether it's LLC or personal, and then it also boils down to the investment being a like-kind exchange. Like you're not going from investment property to second home or vice versa. It's investment to investment, regardless if it's short term or long.
Exactly. Yep. Exactly. And yeah, so you can like I alluded to earlier, like you can really get off in the weeds with like kind, because we do exchanges for like cell phone towers, air rights, I mean, all sorts of crazy stuff. So water rights is a huge thing on the West Coast. So yeah, you can, that's all like kind because it's all technically business or investment use property. But yeah, at the end of the day, just basically the thing to remember, the same taxpayer on title that sells just needs to be the same one that buys. However you want to do that, up to you.
Okay, awesome. That's really cool because I have a house that I own personally that I'm trying to sell right now. That's a short-term rental. It's netting like $5,000 a month. It's really hard to give up, but I
Sure.
need to 1031 exchange it to buy the place here in Hawaii. So I'm trying to move that
Sure.
and move.
Sure.
I'll see here.
And one other thing to remember, I didn't talk about this, but after 2 years, after exchanging in your property, after 2 years, you can move into it and do with it whatever you want at that point. So a lot of people do this, especially retirees. Like, you know, you'll have a retired Boeing engineer in Seattle, and you know he owns 7 or 8 rentals in the area. He's sick of managing properties, but he loves real estate. So he's going to exchange that into his dream home in San Diego on the ocean. And all he needs to do is get some minimal rent on it for a couple of years. And then after 2 years, he can move into there, retire there, die there, pass it on to his heirs tax-free.
Can he also sell it within 2 years after that and like wipe out all the taxes?
No, so no. Basically, okay. He would have to hold it for 5 years, and even then, he wouldn't get rid of all the taxes. He could get rid of a percentage of them.
Sorry, one more question. I know I'm like
Sure.
I'm just trying to figure this thing out. Like let's say I've got a bunch of little like single family homes. Can I just like one by one put them all into like the same DST? And then at the same time, once they're in the same DST, then I can like roll it into like another large multifamily or like in the future or something.
Yeah, absolutely. But DSTs aren't, I mean, real estate itself is not truly liquid, but DSTs definitely aren't liquid. I think you can find short-term DSTs and longer term, but most I think are generally 5 to 7 years. So after say you have a DST that the property is going to sell targeted in 5 years. When that property sells, you don't have to go to another DST. Like people in Washington, for example, they think the market's super hot and it's going to cool down at some point. And so they're going to go into a DST for 4 or 5 years, and they figure that housing will come back to life or whatever the case is. And they want to go back into, fee simple properties that they can keep their eye on in a few years. They just want to back off for a minute.
Cool. Thank you.
Those are great questions. Anybody else got some questions? I've got more if nobody else has.
Yeah.
I've got some fun, complicated ones for you, Kyle.
Okay.
All right. So so I have done a couple of partnership agreements with folks, and we've acquired multifamilies together.
Okay.
And we bought them in an LLC where we are co-owners.
Kakoa, real quick, I did not plug my computer in. I've been at my desk all day. It says 10% low battery. So if for some reason I drop off, I apologize, but I'm not going to get up and find the plug-in or anything. So keep going.
Oh, you're probably, okay, yeah, good. So then if there's 2 owners by operating agreement, 1 LLC, and then they want to sell the property in the future, and they decide not to stay together to exchange into another property, everybody's
Sure.
friends, can they switch or not switch? Can they change and no longer work together and both do a 1031 out of an asset?
Yeah, so like if Kakoa and I are in an LLC together, that's not disregarded for tax purposes. That LLC is the taxpayer. The Kakoa and Kyle LLC is on title. That's who needs to do the exchange. But our tastes differ now, and I want to go into single family and he wants to go commercial, so we're going to split up. But we don't want to buy as that same LLC and have to buy the same property. We want to go our separate ways. So you can do what's called a drop and swap, where you break up the partnership before the exchange and deed out as tenants in common. That way, Kyle can buy his own property, Kakoa can buy his own property, and we've gone our separate ways. That being said, if you do that immediately preceding an exchange, like say within a year or so, sometimes even 2 years, depending on your CPA, that can be considered a very aggressive tax position by the IRS. Because if Kakoa and I have owned this building for the last 20 years, and then 3 weeks before it closes, we deed out as tenants in common and do exchanges as individuals, the IRS could very well come back and say, you guys took preferential tax treatment with the 1031. You guys haven't even paid taxes for it. The LLC has been paying taxes for 20 years. That's who should get preferential tax treatment with the 1031, not you guys as individuals. So potentially the IRS could come after you. So we would always defer that to the CPA, because some CPAs are very comfortable with it. They don't care. As a rule of thumb, some are very, very particular about it. So it's ultimately up to your tax advisor if that's a safe route to go.
That's awesome. That's great. So you just brought up something that for some of the benefit of everybody on it, the TIC, the TIC, or the tenants in common, you brought up, you move into the TIC, just really high level. Why is a TIC important when it comes to a 1031?
So a TIC is just important because it gives you, room to move around. Because if we're all in an LLC together, we're stuck. But if we're tenants in common, it gives us leverage to do whatever we want. Like we don't have to buy the same property again. Kakoa, Daniel, Jonathan, I can all go our separate ways. We don't want to be together. We don't want to buy the same property. We have different tastes now. So if you're on title as tenants in common, I mean, it might be 4 single member LLCs. It might be you might be on title as individuals, whatever the case is. It just gives you more room to maneuver. If you eventually want to go your separate way, you're not locked in with someone else.
Yeah, that's awesome. Good stuff. Yeah, tenants in common, I'm learning a lot more about the power of that, and man, it's amazing. So it'll be pretty cool. Can somebody, and then if anybody else has other questions, get ready, because I'll ask this and then we can go back to whoever's got more questions. So if you're, well, I'll just put it in my context. So we got this 160 unit building in Vegas. I think we're going to do our first syndication. So we're going to create a TIC. And so in that TIC, can somebody 1031 into the TIC?
So they have to buy interest in the property. So like you can't buy a partnership interest like a syndication. So they need to actually go on title to the property. So if the partnership, the syndication is the one on title, I mean, I can't exchange into that as a 5% owner. I would need to exchange as a 5% owner of that building, that property itself.
Gotcha. So, okay. Yeah, that makes sense to me.
Yeah.
That's good.
Yeah.
That's good. All kinds of nuances, but such a great way to do tax-free investing. So
yeah.
Majority of the time, syndications, we can't 1031 into or out of syndications. Is that correct?
Correct. Yeah. But I've seen syndications where they'll allow exchangers in to go on title, and then they basically round them all up and they'll put them under the syndicate, 6 months later or whatever, and do it that way. But we don't, since they're not exchangeable, we don't do much with syndications, but I've seen that done before.
Well, we're going to get creative on you, Kyle. So stand by.
There you go.
Where there's a will, there's a way. And I want to figure out a way, because 1031 into and out of syndications would be powerful.
Yeah, absolutely.
It happen, Kikar. That's super interesting too. I think a lot of us if you can combine those two, that would be awesome.
Yeah, no, we're gonna find a way. I finally found, I've interviewed so many CPAs. I finally found a CPA that's willing to talk about it. So we'll make it happen. We may have lost Kyle. He's running out of juice, but I think, is there anybody else got any other questions? This is great. Great questions, Daniel. I think we asked all the questions, Daniel, Jonathan, and I.
You guys did a great job. Great job.
Thanks. Alex, say something so we don't feel like we talk the whole time.
I think you're doing a really good job. I like listening.
That's awesome. Basically, because you're not paying attention.
We got Kyle back too.
I'm just kidding.
Oh, no.
There's Kyle. He's plugging in. Anybody have any other questions as you're listening in? You can drop them in the chat if you like.
I got one for Kyle. What is the most? Did he just disappear again? I think we just lost him again.
May have disappeared.
I'll wait till he comes back, if he comes back.
It's good. I love it. This is a great topic, actually. Very fascinating.
Hey, let's do a show of hands here. Who in this room would be interested in everyone partnering together on a multifamily deal or doing syndication. There's the raise hand thing. I see Matt's already ready to go.
Matt's in. Ben's in.
No, I'm always in. I'm ready.
Same.
Yeah. So I said, it looks like we at least have 10, maybe more.
Yeah, we don't need much. Jonathan, yeah, woof. I mean, we got a couple of deals that we'll throw out since there's a lot of folks interested in it. It's a fascinating market to be in, and the syndications are powerful tools. And yeah, this would be awesome.
Especially with you running the ship.
Let's not take too much responsibility for that. We can find the good deals, but what is good? It would be a lot of fun though. I've discovered that doing a syndication with people you love doing life with is great. It's bad if it goes wrong because now all of your friends are no longer your friends. But I always say, when you're working with friends, always put it in writing. Because we're friends, we put it in writing. And so we get everything down in advance, and it's very successful because everybody just works as a team. So it's super cool. But awesome. Well, in case Kyle doesn't come back, feel free, if anybody's got additional questions on the Facebook page, we'll have the show on there, and then you're welcome to ask some more questions. I'll see if Kyle can jump back on. If you need Kyle's information, he had put up that initial slide, which I don't have. I've got him on my speed dial. Here's his, Alex, will you write this in real quick? Kyle.williams@ipx1031.com. Kyle.williams@ipx1031.com. That's his email address. Feel free to reach out to him. He literally is one of the greatest guys when it comes to just teaching and coaching and problem solving. It would be, yep, that's perfect. He would be fantastic as we brainstorm some things together. And anybody, if you've got a really amazing CPA that loves syndications and taxes and exchanges, I think I've found one that's going to help us create something that will allow us to 1031 in and out, which would be huge. For anybody who's brand new and doesn't know what that means, it means that if you put in 50 grand into a syndication, we buy a massive complex. When we go sell that, and so your 50 becomes 100, you'd be able to take that 100 and go exchange that into another property. And then if we have another big syndication that we buy, say, down in San Antonio, Alex came up with this really amazing property, then we could all take our 1031 money and take it from one syndication to another. Right now, that's really difficult to do, but it's only a matter of time before somebody pushes through how to make that happen. So it might as well be us. And Kyle's back. You look even better than you did before.
Split second, I plugged it in and the computer went dead.
No, you're awesome, actually. And we've taken a lot of your time. I promise you we weren't going to take a ton of your time. You're gracious today to jump in. Awesome questions overall. Anybody have any other questions while Kyle is back? We just gave them your cell phone number, your personal address.
Awesome.
Yeah.
That's fine. You guys can give me a call. I'll answer the phone. I don't have a life, so.
Actually, I didn't give them your cell phone number. We gave them your email address is kyle.williams@ipx1031.com.
Yep.
So that way they can reach out to you there. And
perfect.
Then,
I got a quick question.
Go ahead,
Kyle. Kyle, what are the let's make it into the 3 answers. What is the most common mistake investors make with the 1031 exchange? And then I'd say for the second and third answer would be, what is, I'd say the one thing that you see come up with investors doing 1031s that they always oversee? It's not a common mistake, but it's just something that always gets overseen in the process.
So it's hard to mess up a 1031. Good questions, and people ask that all the time, like, well, what should I watch out for? The biggest thing, and this doesn't even happen anymore, is that people would drag their feet finding new property. Like a few years ago, people were like, oh yeah, I can take my time, and now they know they have to find something in 45 days. So they all instinctively know I need to be on the ball. But other than that, I mean, it's fairly straightforward. They're buying for equal or greater value, and they're buying new investment property, but they just have to find something quickly. So there's not really anything that people overlook. I would say it has to do more with, like, if you're, do you want to be in a partnership with this person? If not, or these people, if not, have you planned it out well enough in advance that your CPA would say, yeah, that's fine, break up the partnership, and then, you know, you go on title as a tenant in common. But that's more like advanced stuff. But for most people, it's really just find new property as soon as you can.
Awesome. Thank you.
Yep.
Anybody else have any other questions that we need to get addressed before we lose the wizard on 1031s?
Carl.
Yes,
Wait, can you
one
hear me?
last
Oh.
clarification.
Oh.
Looks like we got two, Jonathan and Kurt. So
Jonathan, you can go first. Go ahead,
Okay.
Jonathan.
Thanks, Kurt. So in the situation where like two people are partnered on a property and they sell it, do both people have to roll into the new one, or can they kind of just take their different split of the first property and each do their own?
Yeah, so if they're tenants in common, they can go their separate ways. One can cash out and pay taxes. The other one can do an exchange, which that's common too, because a lot of times people say, hey, I don't want to own real estate anymore. I want to buy Amazon stock. But the other partner says, I want to buy real estate and I don't want to pay taxes, so I'm going to do an exchange. That's perfectly fine.
Okay, cool. So it just depends if it was tenants in common or joint tenancy.
Correct. Yeah.
So it's only smooth if it's tenants in common.
Yeah, or like joint tenants with spouses. But yeah, so if it's like a partnership though, that's not disregarded for tax purposes, where it's two people that aren't spouses, then yeah, it can be messy. Sometimes it works out perfectly, but yeah, tenants in common generally seems to be the route to go for people to have the most leverage with how they want to move forward.
Okay, real cool. Thanks.
Yep.
And Jonathan, like Kyle said, you can always do a drop-in swap. You know, if you have an LLC now with somebody, you can always drop into a TIC. And if you need a good attorney for TICs, I'll give you mine.
Okay, cool.
Yeah.
I think Kurt had a question.
Kurt, Jonathan.
Kurt.
Hey, Kyle, how you doing?
Hey, Kurt.
Can you hear me? I work with Tiffany here back here, so Tiffany Davies. So
Yeah.
why don't you explain everybody? I'm sure everybody knows, but maybe the update that could be possibly going on with the new administration pursuing through Congress. Maybe just touch on that, on the changes.
Yeah, so
it can affect on investors.
Yeah, so it's super tough to say right now. I mean, my lean would be, I don't think anything happens, but we just don't know. I mean, and I don't think President Biden knows how this will all play out either. Because it's basically gridlocked. I mean, technically Democrats do have control of the houses, as Vice President Harris has a tie-breaking vote and all, but at the end of the day, it's still, there's still some, more moderate Democrats that could hold things up for tax legislation that would include 1031. So it's really tough to say right now. I mean, I don't think anyone knows how it'll play out, but it's definitely a threat.
So the word saying is how normally you would do an exchange, and then for your children, so they don't have to pay tax on that. What they're trying to do is defer the tax. So you can't do that anymore. So that's going through Congress right now. And I don't know how the voting is going to be, but I feel that it's not going to pass, but it's always a threat to 1031 exchange.
Absolutely. It's not in any current bills as it stands. But at the end of the day, they definitely brought it up, and I think would probably like to put it in some legislation. But, a lot of people on both sides of the aisle, Republicans and Democrats, do 1031s. I mean, it's the greatest wealth building tool for the middle class. So, would both parties cut their nose to spite their face? Maybe, but for something this big, it's tough to say.
Yeah, and then I work in title. I guess what you identify is if you're working whatever title company you're working with, like you mentioned before, Kyle, make sure you identify your property. That's the key thing on title and escrow side. If you don't identify it, it becomes a very challenge as well too. And also maybe bring up, I know exchanges go through most of the time, Kyle, but say someone gets cold feet, say, you know what, I don't want to do this, cancel this. Maybe go over there's a waiting period, correct?
Yeah, so we cannot refund funds until after day 45. But if a client's identified property, we can't refund the balance until after day 180.
Perfect. Thank you, Kyle.
Yep.
And thank you, Keiko.
Yep.
Anytime. Those are great.
Thank you,
questions.
everyone.
Everybody's always curious about what Biden's going to do on that. That's a big topic. So
Yep.
good stuff. Any other questions for Kyle? Kyle, I think you did awesome. We all got a lot out of it. We're all inspired. We got your information there on the chat, so folks can contact you. And then, yeah, really appreciate it. You're fantastic.
Awesome.
And, thanks everybody for jumping in on the call today. Kyle, if you need to drop off, you're welcome to.
Okay.
We'll probably stick in just to catch up on any other
Good.
items. But
Awesome.
definitely a huge mahalo to you. And
Yes. Thanks, everyone.
yeah, we appreciate it. Anybody else got any other announcements or anything that you need as we wrap up this Friday and we're rolling into another month in August? Any other final needs, thoughts, challenges?
Kiko, if you want someone for the DST, I can bring someone to talk about that if you guys are interested.
Oh yeah, will you shoot me an email on that?
I will definitely do that.
I think you got my email, yeah. So just keikoa this is keikoa at teamkeikoa.com.
Gotcha. Thank you.
Yeah, no, thank you. DSTs are cool. BLTs are good too, but they don't get you very far on tax savings.
But I do like BLTs.
Yeah, no, 100%. That's actually, now I'm getting hungry now that we started talking about it.
I feel like every call you talk about some type of food make me hungry too.
Yeah, I'm kind of a foodie at heart. I'm not a good foodie. I just like food. So, we just gotta like food. It's awesome. Hey, if anybody, just to all the folks that are, anybody's looking to get your real estate license or got a real estate license and you're in any of our multifamily target markets and you're looking for an opportunity to work with us, hit me up. We're trying to add to our real estate team of multifamily experts. So if anybody knows of anybody, that would be awesome. You don't have to have any experience, just a license.
Also, one more thing, guys. I'd like to also get a show of interest. We're going to be blessed with Keikoa's presence in September. He's going to be on the island. We're thinking about renting out a boat here and doing a little mastermind like sunset cruise with, I'd say, most of our top guys that are with us, and then also newer investors that want to get involved or just do a good night of networking. So we're thinking we'll rent out a boat. It'll be like a 3-hour cruise. There'll be some drinks and food provided. Most likely the ticket price will be somewhere between $60 to $100. We will be comping a few of our clients, and we'll probably give away 1 or 2 on the coffee talk call before we do it. But I just wanted to see how many people would be interested in doing something like that. Probably be between like September 19th through around September 25th, one of those days. You can say yes, show of hands, or just type yes in the chat box if you would be interested.
You didn't make it sound very exciting, Alex. You should be like, we're going to talk about real estate and we're going to be in Speedos and bikinis and we're going to have margaritas. And then suddenly it's like, yeah, no, Daniel Kong's now, look, right there. I'd be down.
As long as I want to see Alex in the bikini, I'm all for that, man. I'd pay good money for that.
Oh, I mean, if that's what it's going to take to sell out the boat, Keiko and I will both get in bikinis.
Done. Done. We're ready. That's awesome. No, that's cool. I'm glad you brought that up, Alex. I think, yeah, the heart behind that is that it's just a chance for us to get together. If anybody's got time, you just want to talk story and hang out. It'd be great, great networking and a lot of fun, and nothing super official, but more just, building that relationship. So we got through a whole year of talking through Zooms, might as well get a chance to talk in person. So we'll get you some information out. I think we're looking at, Alex is trying to book us a boat. If you're seasick, it's no problem. You just drink more and then you're fine. So that's there's your tip of the day. So,
and I went on the boat. It's very smooth. It's not a rocky one. There was pretty good swells out there and it was chill. So it's a 1929 wooden yacht that was actually commandeered by the Navy over here and used for sonar. So there's a lot of cool history with the boat too.
That is cool. So probably somewhere around that September 19th-ish time, if anyone's got time, we'll chat. And if anybody's on Maui this weekend, shoot me a message. Got a whole bunch of us flying in to do some minding? I don't know.
you're gonna mine the mine, so I guess you can
Right.
call that mining.
Maybe that's what they call it. That's cool. Right on. This was awesome. I'm all inspired now to go do some more 1031s. Fantastic. Anybody else got any final announcements for this Friday afternoon? The sunshine is finally out in Seattle today, so everybody in Seattle, get outside. Steve Goodman's like, what? Really? Look. It's a miracle.
Like now we're here. I mean, yeah, it's cloudy. It's been misting and raining a little bit all day, but we need it. All the grass is dead.
Oh yeah, 100%, bro. I'm the same way. I'm like, do we water our lawn like ongoing? Like it's a fire hazard. Apparently it's a fire hazard. So
yeah.
I'm just happy to see football back.
Right?
Yes.